Right?
Yeah,
How will they look is the question from here out.
Things are looking fine. I think March volatility was a little torrid, as you mentioned on the show a little while ago, that mid-March, quite a large number of names which were the best performers going into March last 6 or 8 months took a bit of a knock, right? So mid-caps and PSUs all suddenly fell 15-20% in a span of 7, 8, 9 days, and mid-caps maybe 3 or 4 weeks. All of them seems to have clawed back. So two things are helping the market sentiment in the near term. There is a clear dovish tilt by the Fed in the March 20th meeting, although they keep on going a little bit back and forth in the subsequent statements. But I think on the whole, the tilt is dovish. And second, our strategist was telling us that most 2 months or 3 months going into elections, the markets have been strong because the optimism starts to creep in what the new government will do, things they could not do in the previous term.
We'll get manifestos shortly. I mean, I think next week we'll get the manifestos, right?
Yeah.
And people will pore over them.
Correct.
Hopefully they'll be well detailed on the economic front.
Correct.
So that should act as a trigger.
Yeah, that could act as a trigger. And optimism is building up that number of unfinished agendas of the last term could get completed in the next term, etc. This always happens. So yeah, we could see a near-term bit of a move. Medium term, I think the markets will continue to be choppy. That's my view.
Okay, so near term you could see a move. But we're getting a lot of questions from viewers, from investors about what happens post the elections, right?
Yeah.
Because if this is a build-up to the elections and once that whole election trigger plays out, then do we normalize to sort of, I mean, are we getting into sort of a time-wise correction for the market? Is it going to be a period of no growth at all? How do we approach it throughout this calendar year?
So throughout this calendar year, I've been of the view the markets, what I call it non-linear. So we saw sort of a linear markets over the last 12 months. Very small pullbacks and markets kept on rallying. This year, I think markets will be non-linear. So you'll see a lot of ups and downs through the year. For the whole year, I wouldn't be surprised if we close the year in a plus minus 5% range and not a huge return the way we saw last year. The reason for that is if you see the earnings performance of the large caps, there's a lot of dispersion trends. So capex-oriented or investment-oriented businesses are still doing okay, but they're slightly richly valued. Consumption weakness, which started with only rural weakness a quarter or 2 quarters ago, now seems to be percolating upwards even to the urban products and demand. That's a little bit of a worry. So there are cycles and then there are counter cycles which is happening, which in my view is a little bit of a risk for earnings going forward. And the margin benefit which the companies got because of sharp fall in WPI will start to fade away soon.
You know, I was just wondering, some of these commodity prices are moving up. What's going to happen to some of those, you know, say those wire makers, those cables companies? You know, suddenly you'll start factoring in that, hey, commodity prices are going up, and that's what's going to hurt the margin. So let's see how that goes. But since we were on the topic of elections, and I think that you were in the camp that's like two-wheelers, you know, what are the other themes you look to play? Staples have been big underperformers. We had a note coming in from Motilal Oswal who said they rather look at staples now in comparison to discretionary, where discretionary actually has been the big outperformer. But they believe the time has come to look at staples. Your take?
I continue to be slightly negative on staples.
Okay. And the two-wheeler theme you still like?
Two-wheeler theme I liked, but from the current prices and the current valuations, I'm slightly more cautious.
Okay.
The stocks have done phenomenal run. For example, Bajaj has done almost 50% kind of a run over the last 5 or 6 months. Hero has done beautifully. So has TVS. So there's also how, I mean, market these days tend to price in year and a half or 2 years of outlook within months, right?
Yeah.
So it is the second thing which I've been continuously saying, and I've, I think mentioned this a couple of times on your show, is it's a very retail-driven market.
Yeah.
So two things are happening. One, near-term earnings triggers get immediately priced in. Second, there is a huge amount of weightage on growth over everything else. So, you know, the whole valuation framework of the market keeps on moving. 2014 to 620, all of us moved to just DCF, and we started talking about terminal value and what's the long-term value in the particular business or stock. I think we have done a full round trip and gone back to 90s, which is plain and simple PEG. What is the growth and what is the PE relative to that growth? So, which is why when slight amount of growth disappointments, you see sharp pullbacks in the stock prices as well. one is the business. Second is I would keep an eye on what the valuation respective to the growth is.
You know, retail is driving the stock market, but the government is driving some of the policy-led initiatives, right? Which is leading outperformance in sectors, infrastructure, capital goods, railways, metros, defense, etc., etc. You said unfinished agenda, market will focus on. Very quickly, we'll get to know what's in the manifestos, etc. But to your mind, I mean, at the team at Ambit, what's happening? What's the view like? Which are the sectors where this unfinished business will find most resonance in?
I think in terms of sectors and specific push with respect to either the capex plan or PLI, the government has already done a fantastic job. What I would like to see, I don't know whether this will happen or not. What I would like to see is the.
We all have our wish list. Go for
it. So the labor reforms, which was attempted but pulled out, comes back on the table with the new mandate.
The labor reforms, sorry.
Labor reforms which are tabled and sort of pulled back. Some structural changes on the agriculture side, which was also tabled and pulled back in the previous term. I hope some of it comes back because it's time we do touch some of these holy cows in the country, and same for land acquisition. So the next big thrust India requires is manufacturing. There's a lot of articles and strategy reports being written on why, despite the economy doing well and GDP growth being strong, unemployment problem is still not fully solved,
so
and that can be solved.
There is just one thing. The interim budget which came, right? Look at the allocations made there across railways, across roads, etc., etc. Many of these areas, allocations actually, the growth in allocations has slowed down materially.
Correct.
And that's the reason many economists pointed out that there's only so much the government can do.
Correct.
Right? There's absorptive capacity of the economy as well. You can't just keep putting in money into these sectors. That will not change even as they come back. So what does that mean for, as a theme is great, capital goods and PLI, etc. But you're reaching limits in terms of how much more the government can do. It's the private sector then.
Yeah.
Will that show up in that way in stocks as well? That maybe they take a back seat. That remains the focus, but the government is kind of taking a back seat as they've told us, and that perhaps will not change when the full budget also comes.
Not necessarily, because see, many of these companies have notched up order book. So book-to-bill ratio is reaching 3.5, 4.5 times, right? I'll just give an example of BHEL from 2003 to 7 or 2004 to 7, just to illustrate my point. So bulk of the order book for BHEL actually came pre-2004. But bulk of the execution happened between 4 to 7. And while generally it is believed that capital goods companies perform only when the orders come in and not when the earnings are delivered, it's not really so. So capital goods start to perform when the orders start to come in. But if the earnings growth is also very strong, the performance continues. So over 4 to 7, BHEL delivered on the projects, executed, and in power projects, typically the last 2 years is when most of the margins also get booked. So as the projects come for completion, the margins also see a bump up. And it was one of the best performing stocks of that time period. So same thing can happen here. Fresh order intake might slow down, but book to bill is 4 times, 4.5 times in many of these cases. As they get executed, and towards the second half of execution is where bulk of the margins get booked. Earnings growth can still stay robust.
Okay, by the way, the stock of the moment is Avenue Supermart. Just look at that, 5.5% rally now on that stock, and big volumes coming through as well on Avenue Supermarts this morning. The market cap has now exceeded over 3 lakh crores for Avenue Supermarts. It has come back in a big way. It just talks about how perhaps consumption has come back, right? But just trying to get your view on this entire sector. How do you pick and choose in terms of both valuation as well as growth now?
So, 2 or 3 things. One is, one of the biggest trend in the consumption sector is formalization. That trend started in, let's say, 2017 or 18, gathered pace post 2020, 21. So there are a few spaces, and Avenue is a classic example of that, right? So there are a few spaces within the consumption space where even if the headline growth is a little slower, some of the stronger names in the sector can continue to grow at a very fast clip because informal is still a large part of the pie as compared to the formal. So grocery retail is one such example where informal is still a small fraction. And hence, the more organized retail in grocery has a very long runway of growth, which is what Avenue is benefiting from. The growth had slowed down a bit. A small sign of a pickup in the last 2 quarters, and the stock's been doing very well. There are a few spaces. I mean, jewelry is another such example, where still the unorganized has a large section of the whole pie, and hence the organized can...
So at this price and at these valuations, you're still comfortable with names like Avenue?
I mean, I'm not commenting on the specific stock price move here, but I think that's you asked me a question on what the framework one should use. The framework I think one should use is if there is still large informal to formal shift happening, at least one can take a bet on a longer runway for growth. And then, I mean, valuations is another matter. You have to link it to that.
All right, Dheeraj, appreciate you coming down to the studio and sharing all those thoughts with us. Wishing you a good day ahead and look forward to having a chat with you rather soon.
Sure, thank you.
Well, let's focus on another company then, BEML. Well, that could be, that is a big Make in India theme. And also it has exposure to various segments, whether it's metros, railways, defense, all those segments are flourishing. And the company will be at the center of it. Well, to understand more about how business is shaping up, we're joined by Mr. Shantanu Roy, the CMD of the company. Hi, Mr. Roy, good morning, and always good to speak to you. Well, let's get the basics out of the way. You've won some orders in the last quarter. So give us an updated order book and break it up segment-wise as well.
Very good morning, Nigel. We definitely have won some orders in the last quarter as well as the last financial year. And the new financial year is again a new beginning for us. Unfortunately, I cannot talk about the present order book that we have since we are in the silent period now. But I can give you a glimpse of the order book of the opportunity size. So talking about the defense opportunity size for 24-25, we have an opportunity size of around 6,000 crores. If I talk about the rail and metro business vertical, we have an opportunity size of around 58,000 crores, out of which around 44,000 crore will be from the rail and 14,000 crore will be from the metro. And if I talk about the mining has always been like that, in an opportunity size of around 3,000 crores every year. And that has been giving us a baseline till now.
Okay. And how optimistic are you that you can get a bulk of this? Defense, I think you mentioned 6,000 crores, rail and metro 58,000 crores, and mining 3,000 crores. What should be a rough hit ratio? This is the opportunity size, I'm guessing, and you would get some part of this.
Yes. The rough hit estimate should be around 50% in rail and metro, as well as mining, as well as defense. Whereas in mining, it should be more than 80%.
Okay, so in defense particularly, you're saying 50%, so around 3,000 crores. But the last time when we spoke to you, you had said that in the next 3 to 4 years, you can expect about 7,000-8,000 crores of defense orders. Do you stand by that, long-term target? And if you can tell us, where do you see the maximum opportunity in the defense space? Is it in high mobility vehicles? Is it in armor recovery vehicles? Just trying to understand where is the traction now?
You're very right. Let me correct you a bit. The opportunity size that I spoke about is for 24-25. And when I said that we can look at a number of around 6,000 to 7,000 crore, what I meant was that it will be the sales numbers in the coming 4 to 5 years. Now the opportunity size for us in the segments, in the core capabilities that we have presently for the coming 4 to 5 years is around 40,000 crores. And the bulk of it will come from the high mobility vehicles. The bulk of it will come from the combat engineering. The bulk of it will come from the armored vehicles. I'm not talking about, the diversification efforts that we'll be putting on, especially, the new business areas, new growth areas. If we are able to do that, this opportunity size will definitely double.
Okay, so that is for defense. Got it. Just to follow up on the metro order book as well, you said the opportunity size is 14,000 crores and from that you're expecting to bag about 50%. So we're looking at about 7,000 crores for FY25. Correct me if I'm wrong. And from that 7,000 crores, can you tell us, what are the different projects across regions, Bangalore, Mumbai, Hyderabad? What is the kind of visibility that you have in terms of both getting orders as well as execution in the next 1 to 2 years?
First, let me talk about the order book, the order opportunities. Order opportunity is the Chennai Metro. There are 2 projects in Chennai. Then Mumbai, we have 3 projects which have already been announced. The tender is out. We also have, some extension in the existing order book for Bangalore Metro. We will have more opportunity for the Bangalore Metro, the new lines that have been announced. We also have the Patna Metro. So these are the opportunities that are right there in front of us. As far as the execution is concerned, we have basically 2 projects in Metro which are under execution. One is the Mumbai Metro, Line 2, Line 7, and the second is the Bangalore Metro for the 318 cars. So these are the 2 projects which are under execution presently.
Mr. Roy, good morning. Good to see you back on the program, sir. So, for each of these segments, defense, rail and metro, what is the outline of a visible pipeline over the next couple of years? If you can give us those numbers.
Well, I think I gave you an outline about the 24-25 financial year.
Yeah,
and I also
beyond
gave an
24
outline about the next 4 to 5 years in defense and rail and metro. So
Right.
we can extrapolate from that basically, and it need not be double in the next year. So what I can see is that from the rail and metro sector itself, there can be an opportunity size of around 90,000 crores in the next couple of years, including this year. And from the defense and aerospace, it should be around 50,000 crore for, it should be around 12 to 15,000 crore for BML.
Specifically on defense and defense vehicles, right? Armored vehicles, etc., which is a big focus area for the government, to strengthen border security, etc. Could you tell us what is the, is it going to be a fast growing segment as you see it? And what can be the opportunity size here, Mr. Roy?
If we talk about the numbers, the opportunity size that we are presently having is around 6,000 crore, which hovers around the high mobility vehicle and as well as the armored vehicles. And there are various variants of the high mobility vehicle for different usages. For example, the platforms for the missile systems, platforms for the strategic forces command. So all put together, this number that I have just mentioned is all put together. And in the coming years also, the 40,000 crore of opportunity size that I just mentioned, it also is basically from the high mobility vehicle and the armored recovery vehicle, plus various variants of the same. As I said, these are our core competencies, and the core competencies are the armored recovery vehicle, the high mobility vehicle, the combat engineering, the bridging systems, which form a part of the combat engineering, the mining, demining, mine layering equipment, which again are part of our combat engineering segment. And on top of this, we have developed some new capabilities in engines. So that should augur well for the company, especially for the main battle tanks that are to come in the future, as well as the existing fleet of the main battle tanks.
Just a very near-term question, Mr. Roy. With elections sort of upon us, will the first quarter largely be very small in as far as fresh order intake is concerned, or work goes on? Tendering, ordering, yeah.
Work definitely goes on. Already certain all these opportunities are in the pipeline, but yes, it may not fructify in the first quarter. It may go up to the second quarter or the third quarter.
Okay, all right. Mr. Roy, just to confirm, so your order book is looking good. The order book opportunity as well is solid. So, most analysts on the street, they believe that you can grow in high teens to around 20% on a CAGR basis for the next few years. That's doable, right?
It is definitely doable.
Okay.
You see, the last year, as I said, it was survive, revive, and thrive. So last year was survival for us. This year will be a year of consolidation for us, and last year, we also had 3 signature moves which will drive the company forward. One was the engine, second was the Vande Bharat, and the third was the high-end mining equipment that we developed. And we can also expect at more signature moves from the company in the coming years, in the coming couple of years.
Okay, all right. So revenue growth of roughly around, on an average, CAGR of close to around 18 to 20% is what we can work with. That's the takeaway that I'm getting for the next 3-4 years.
Yeah, we can work with. Yes.
All right, let's work.
That is an uphill task, I must say.
That's an uphill task. And what's gettable? 15%, 16%? Is that gettable?
You see, we are aiming at 20%.
20%. Got it. Okay, so revenue growth is out of the way. I wanted to focus on margins. I'm reading a Prabhudas Leela note, and they're saying that they expect margins to scale to 13.6% in comparison to around that 10%. And the reason they've given is 25% of your workforce is expected to retire in the next 2 years. So employee cost as a percentage of sales will drop around 370 basis points. Do you think that's well and truly on? FY26, the margins are closer to around 14%?
You see, it's very difficult for me to, envisage that as at this point of time. What I can say is that the employee cost, we will try to keep it around 20% or around 18%. I don't see it coming down drastically. Number two, even if 25% of the workforce is going to retire in the next couple of years, we are going to have new people on board. In fact, we have already started a massive recruitment drive, and the guys that we have recruited, they are expected to come on board by May. And if we have to grow, we need a workforce also. So the absolute numbers may go up in terms of the revenue cost, in terms of the employee cost, sorry. But the percentage is likely to remain at around this number only. And as far as the margins are concerned, as I said earlier, definitely it will be a much improved number this year. We are expected to hit good numbers. Let us see how it happens. And in the future also, the number that has been speculated, it may happen if we are able to achieve our sales numbers. Because we have a fixed cost, which remains more or less the fixed in number. So as much as the revenue goes up, our margins also go up.
Okay, got that.
Simple,
you spoke about... Okay. You spoke about, a 90,000 crore opportunity size in the next 2 to 3 years in rail and metro. I also want to understand, is there any pickup in activity in the international business? Because so far it's a very small portion, but I do know from the last time we chatted that you are looking to expand your presence there. Can you tell us what the next 2 to 3 years would look like and what's the opportunity size?
Well, in international business, traditionally, we have done only mining construction. 95% of our exports has been through mining and construction only. However, we are working on a couple of international projects for the metro sector. And we are also trying to have our maiden entry in the defense exports. So as far as the opportunity size is concerned, it is huge in the international market. But we would like to grow at maybe 5% to 10% as far as our exports are concerned in the coming 2 to 3 years.
So these international metro projects, any idea on what the ballpark size could be in terms of crores? What are we looking at over the next 2 to 3 years, and which geographies are you seeing maximum demand coming from?
The geographies are basically the Middle East and South America. And if I talk about the ballpark figure, it should be in the range of around 2,000, 2,500 crores as far as the rolling stock is concerned.
That's over how many years?
That will be over the 2 to 3 years. Normally, that is the time which is needed for the execution.
Okay, Mr. Roy, on that Nigel's question on margins, last time we spoke, I think this was late Feb, you had said that there is some reorganization of the company which is underway, and we'll hear more about it soon. Is there anything you'd want to update us with, sir?
Yeah, we have just restructured the organization, done a complete restructuring into strategic business units to have more focus, to have a better efficiency, to have faster decision making, and also creating a leadership pipeline. So we have just implemented it. We have rolled it out from 1st of April. And the results will take some time to come, but I'm very hopeful that it will be beneficial for the company. A lot of other organizations have already are already working with this model, and they have been pretty successful. So this is a tested model, time-tested model, and we are also pretty confident that this will reap very good dividends for the company.
Okay.
All right.
All right. Rolled out from the 1st of April, as you say, and we'll see results over a period of time. Thank you very much, Mr. Roy. Good speaking with you, sir. Appreciate you joining in here on CNBC TV18. Well, we'll slip into a break here. Just another reminder of the event later today, that is India Exchange, which CNBC TV18 is hosting, where market experts, industry stalwarts will collaborate in insightful discussions on India's economic path and the evolving dynamics of the Indian market. Mapping macros with city economists Samir and Chakrabarti. Later in the evening, there's a jugalbandi between market veterans Manish Chokani and Ramdev Agarwal. Return of animal spirits, V. Vaidyanathan, KK Mystery and Manish Kejriwal. Weigh in and chasing alpha with market experts Nilesh Shah, Prashant Kemka and White Oak Capital. Anish Tawakle will also join us. So tune in to CNBC TV18 today evening, 5:30 p.m. onwards.
Welcome back. Avenue Supermarts reported a very good set of numbers. So let's find out what some of the other players are doing in this market. V-Mart Retail came out with their Q4 business update. That showed an improvement sequentially. The Q4 same-store sales growth came in at 6% versus 4% in Q3. The company added 9 new stores in Q4, taking the total store count at 444. Now, to discuss the demand trends, we are joined by Anand Agarwal, the CFO of V-Mart Retail. Anand, thanks a lot for joining us. So your numbers are showing an improvement on a quarter-on-quarter basis. But is that just because of a favorable base, a low base, or have you seen a genuine improvement in consumer demand?
Well, I think there is definitely some improvement at the ground level. We've been saying that in the past couple of quarters as well. So last 3 to 6 months have definitely improved. So there are two factors which are working here. One is there is definitely a slight improvement in the consumer demand, in the footfalls as well. And second also is a lot of effort that we had put in over the last 1.5 years in improving our internal efficiency in terms of the designs, in terms of the product that we are putting in, and also the price proposition that we are able to provide to the customer at a more sharper price point is, I think, yielding a bit of results. It's too early to say that, whether this is going to, grow further or, how much it is going to grow. But definitely, I can definitely say that, there is some improvement at the ground level. And also some of the internal efficiencies that we've been building on have started to board results.
Okay, but despite an improvement in the ground level, you continue to see a single-digit, low single-digit same-store sales growth. By when do you think you can get to double-digit?
Very difficult to predict, but all our efforts are always to maximize the growth. But I think in the midterm, I think we will still be wanting to, make sure that we at least stick to high single digits, and that's what the goal the team has taken up, and we are all gunning to make sure that we at least reach there. If we are able to surpass that, that's even better. But that's something that definitely we want to target.
Okay, all right. Hi, Mr. Agarwal. Good morning and good to see you. And good to hear that you're seeing at least some signs of improvement. We'll take that same-store sales growth of high single digit for the coming year. I want to focus a little on margins. And the acquired unit that you did, the acquisition that you did a couple of years ago was Unlimited. Now, out there, the margins are still relatively lower in comparison to the core business. When do you see it coming up to steam with what you're doing at V-Mart?
I think we acquired Unlimited 2 years back, and the last 2 years have really been a turnaround story. We've been building a lot of in terms of how we integrate the product, how we change the product, how we get to a new set of customers who are more attuned to our style of offering of value products. And all of that is now started to show some results because we've also seen a 13% like-to-like growth in the Unlimited business in the last quarter. Now, as far as the margins are concerned, I think once we achieve sales per square feet, increment of at least 15 to 20% in the next 1 year or so, we should be able to look at more healthier margin, which are more comparable to the group margins at a much more healthier level.
I just had one follow-up. You said same-store sales growth currently at about 6%. You're expecting it to go to high single digits. But I'm just trying to understand, some of your peers, like say a V2 retail, right? I mean, they saw growth of 40% in Q4. Both of you are literally in the same business, but you're struggling to even see a 10% growth. Why is that?
I really don't want to comment on competitors, but definitely I think what we are trying to do is to make sure that we are able to leverage all our strengths and improve our operations and, gun towards a more sustainable growth, which we can deliver quarter on quarter.
Mr. Agarwal, good morning, Prashant here. Slightly out of the box question, and forgive me if maybe I'm going off tangent, but this is the area. I mean, you've got the network, right? Especially so in the Hindi heartland states. Have you gotten sort of offers from competitors, etc.? Is there? I mean, some sort of a M&A, etc. We could perhaps look at. Is that a possibility at all, or nothing at all?
Definitely not. At least I am not privy to any such offers. And even if I had something, I would definitely not announce it on national television.
But you don't. But you're saying you don't have anything, right? Nothing has come up to you.
What if someone offered you?
I think I'll take it offline then.
Okay. But you're saying that you don't have it as of now. So tell us, elections is a big time, right? In UP, Bihar, all the states where you operate in. How is demand kind of holding up ahead of polling, which is expected to start?
So right now, as I said, I think the demand is definitely looking up. We are seeing more renewed footfalls. We are seeing much better conversions. We are seeing much better offtake in all the Hindi heartland markets. In fact, these markets had been particularly disturbed because of 2 years of bad monsoons, consecutive 2 years of bad monsoons. And this time round, we are definitely seeing a lot of interest. Now, the only challenge which I foresee in the next, at least around the time of elections, is elections usually are very disruptive, and especially in the rural areas. So whenever there are rallies or events, the towns do get disrupted, and that's a bit of a challenge. The second challenge also that I foresee is that Q1 this year unusually has very low number of marriage, auspicious marriage days. So there might be a bit of challenge at least in Q1, but otherwise at a more sustainable level, I am definitely seeing at least for the last 3 to 6 months. Footfalls firming up, demand getting better, definitely as compared to the last 2 years.
Okay. And, we were just talking about competition and how competition is doing very well. I understand that it must be a tough time for you, trying to navigate that. But anything that you are doing to sort of combat competition in terms of either pricing or penetrating the market further, and also in terms of store additions, what are we looking at in FY25?
So we have opened roughly around 46 stores gross this year, and we also closed 19 non-performing stores this year. And we've been on a cleanup spree for the last 2 years at least. And I think in terms of store additions, we should be looking at around 45 to 50 gross store additions next year as well. In the current financial year FY25. There may be a bit of store closures again, maybe not more than 5 to 10, but that's what we have already planned for. In terms of the internal improvements, I think we've done a lot of work around our merchandise, a lot of work around how we supply to replenish to these stores, courtesy the new warehouse that we have set up, which is now fully operational. So there's a lot of improvement which has happened around the pricing and the value proposition that we are able to offer to the customer. And with this renewed product offering and much more fashion, because we have now also set up a full design team, which has been in the works for the last 1.5 years. So almost 40-50% of the products now that we sell at our stores is now internally designed. And that's a very, very big departure from our earlier, avatar. The second very big work that we have done is around quality improvement. So I can very safely say that amongst all our competitors and amongst all our peers, we would have the best quality at the price at which we are able to provide products to the customer. And that purely reflects in the loyalty rates that we are able to enjoy. So our loyalty rates have inched up from 60% to almost 70%. And that's the kind of sustainable growth that we are trying to build, both in terms of product offering as well as customer offering. So that's the moat that we are trying to develop on. Apart from the expansion that we have been, doing in our core areas, not really, dithering away into newer geographies, but basically getting into the cluster-based, expansion that we have always specialized in.
Okay, all right. Final question, Mr. Agarwal. Then you told us about Unlimited. What about LimeRoad? How far away is it from breaking even? Motilal Oswal has come out with a note, and they're saying from a loss of close to around 60 crores, they're expected to break even in FY25. It's on course?
So I'm not too sure whether we'll be able to break even at a full year basis, but definitely by the end of next year, we are definitely looking to break even that business, maybe in the exit quarter or so. But definitely the work that we've been doing is that we've been consecutively bringing down the losses every quarter. And that is what we will keep doing without compromising on a lot of growth. But at the same time, at LimeRoad, the objective is not basically to build it as a top-line engine, as I said earlier as well. The objective is to make it sustainable and aid in the omnification of the overall V-Mart group. So the offline customer at V-Mart stores is able to shop seamlessly on LimeRoad, and vice versa is something that we are trying to build.
Good to hear your thoughts, Mr. Agarwal. We appreciate you joining in. Wishing you all the best, and hopefully FY25 will be a cracker for you as well as your team. Well, let's get back to the markets. From the time we have opened up, actually, it's been a bit of a party pooper, because we started off, we were fresh all-time highs, we were up more than 100 points, the batsmen came out there smacking it out of the park, and suddenly quite a few wickets have tumbled in the last few minutes, and that's why the Nifty now has moved into the red. We're down close to 35 points, and we made this point earlier today. The start is going to be in the green, but we need to build on to that. In fact, the start was much better than what we anticipated. But take a look at a few stocks. Hero MotoCorp has moved to the low point of the day. Shriram Finance as well has seen a bit of a U-turn of sorts. So that stock is well moving lower. And I think a couple of larger names as well, like Infosys, L&T, when they turn, that's what puts pressure. And that's precisely what's taken place. Prashant, the batting order is looking a little bit sticky now.
Well, market breadth is also closed in now, Nigel. So we're back below the 22,526 level, right? Once again. Neither here nor there. Look at the advanced decline ratio. It's kind of closed the gap now on the indices.
But I also think it's important to point out that given everything, the Bank Nifty has been supporting this market quite a bit. So Bank Nifty continues to be in the green, although it's come off a bit. And it's sitting at a 1-month high. So, the consistent performance in the last 1 month. So maybe banks continue to play leadership here.
I think the biggest constituent, HDFC Bank, that's actually dragging the bank. If you pull up a contribution chart, I think bulk of the 250 points will be because of HDFC Bank. That's been the big drag on the index. Yeah. And if that comes to the party, then it's going to be very, very good times.
All right. Well, let's shift focus to Brigade Enterprises, the next company that we're speaking with. It's been a huge outperformer, 100% plus in the last 1 year. So there's a new development. Brigade has signed a joint development agreement with United Oxygen to develop a 3 million square feet office space in Bengaluru. The project is expected to generate a gross development value of around 340 crore rupees. Well, let's discuss this a little bit more. Nirupa Shankar is Joint Managing Director at Brigade Enterprises. Nirupa, great to have you with us here. Good morning. Thanks for your time. Prashant this side. Could you talk to us a little bit about how much investment would you be putting in towards this project? Is this going to be the first of many? Do you already work with this particular player? Just basic hygiene details.
Hi, good morning. Thank you for having me. I'm not sure if I'm visible to you all, but good morning to you.
We can hear you clearly, Nirupa. Yeah, go on.
Okay. So this is a joint development project in Whitefield in East Bangalore, which is known to be one of the, I think one of the very good markets for office absorption in the city. Bangalore as well has been doing extremely well from an office absorption perspective. And this is the first time we're doing the project with this particular landowner and hope to do much more. And in terms of investment, it's a 3 lakh square feet project. And we'll be putting in the average construction cost of that we have for all our projects. And yeah, we're very excited because it's right on the main road, good metro connectivity, and I feel that has been the key for new office absorption. Having good metro connectivity, having good public transport, having good visibility. So we're excited about this.
So this, when you say gross development value, this is office space, right? So we should look at it as lease and rental kind of annuity earnings from this project?
So yes, this is office space, but when we put in the GDV, what we do is we take a assumed rental value and we divide it by a cap rate and figure out, suppose we were to sell it, what could we expect from the sales of this project if we were to sell it, but not necessarily is this a project that we plan to sell? We are planning to lease this project initially, and then let's see. It's just for GDV purposes, certain assumptions are made.
Okay. Nirupa, hi, good morning. I wanted your views on what the rentals could look like. What are the realizations? What are the rentals that you're seeing right now in the commercial space? And how is it compared to what it was, say, 6 months ago?
See, the rentals have been quite stable. Every year, there is typically a 5% escalation in most contracts. We've been able to hold on to that kind of an increase annually. So despite COVID, we've been able to handle a 5% increase per annum in our rentals. So today in White, rentals are anywhere between 60 to 65 rupees for a grade A project. Sometimes it could be lower for older projects, could be in the range of between 50 as well, older projects and depending on the location. But projects with good location and road facing and marquee projects are getting at least between 60 to 65. Now, in 3 years, the way we estimate it is, with a 5% increase per annum, what we can expect there. So in 3 years, I would increase 15% over the existing rentals and assume that value for a rental in 3 years.
So can you give us, for this particular project with United Oxygen, what is the expected rental or realizations that you're looking at?
So for instance, in the GDV, as I mentioned, we've mentioned about 340 odd crores. So the assumed rental is around 75 in this case.
And how much of money are you investing in this JV?
See, typically, it's a joint development. It's not a joint venture. Typically, we do our projects as a mix of 50% debt and 50% equity. That's typically what the financials work out. So accordingly, we put in the average construction cost. Typically, average construction cost, again, it can range anywhere from 3,500 to 4,000 rupees per square foot plus GST and other expenses.
So in terms of an absolute number, what will it be for the project, for the JDA that you're talking about? Absolute terms?
I'll have to calculate that. But like I said, it's a 3 lakh square feet building, and I've given you the construction cost. Yeah.
Got it. And just to reconfirm, for the end of this year, you were targeting around 700 crores of rentals, right? For the piece, for the entire company on the whole.
Yes, that's right. That's right, including our office and retail portfolio.
Nirupa, we can see you as well now. So good to have your video on as well. Just one thing, Nirupa. Is the market as buoyant, as strong, even as a lot of new supply also keeps coming in? The Bangalore market?
Yeah, I think the market is very strong. Overall in real estate, we're seeing decadal highs across most industries, whether it's residential, whether it's hospitality, whether it's retail is also doing extremely well from a sales perspective and sales volume perspective. The office market as well has been quite resilient. In fact, quarter on quarter, I think for the market overall, there's been almost a 40% increase in the overall country market. So I think for this quarter, I think the country has done about 11 million odd square feet of office absorption. And I would say 50% of that can come from markets like Bangalore, Chennai, and Hyderabad. So overall, we are seeing a pretty resilient market. I know that India is sort of a bright spark across what we see globally. Globally, there is a bit of gloom and doom when it comes to office, whether it's the US or Europe or Australia and markets like that. But India and Asia, but India specifically, has been quite resilient in the whole office absorption space. So we are seeing pretty good traction, and we hope that this momentum continues.
So So do you have any plans to expand into new geographies like some of your peers, like Prestige, for example, is getting into Bombay in a big way, gotten into Bombay in a big way? Do you have any plans? And what is the land bank that you're looking at right now? Are you looking at more land buys or expansion?
We've held on to this statement for a while, saying that we will be continuing to focus on our key markets of Bangalore, Chennai and Hyderabad. Of course, there are other smaller markets that we may look at for some amount of office, such as Kochi. GIFT City is also a place where we have some presence. So GIFT City is doing quite well right now. So we might look to do something more there. But apart from that, we typically, again, our strategy has been a mixture of outright and joint development. For office especially, we've been doing a lot more joint developments just because commercially that makes a lot more sense for us.
All right, Nirupa, final question before we let you go. Both for your company as well as for the industry on the whole, what has been the impact of the water crisis on construction? Tell us more.
Yeah, I think water crisis is hitting certain parts of Bangalore. If you look at it, the north side of Bangalore, the west and the south are not so badly hit. I think the grave water crisis is mostly in the eastern parts of Bangalore. What we need to do as responsible builders is to make sure that we use only treated water for construction purposes. Don't use fresh water for construction. We have to make sure that, we do all our rainwater harvesting, recharge pits. We need to increase the water table in all our projects. So we need to make sure that we house a lot of rainwater, make sure that anytime the rains fall, we're able to, again, harvest all that water. And those are the measures all of us need to take. It's possible to have water surplus in some of our projects. We've seen that even in East Bangalore projects, some of them have water surplus because of the responsible measures we have taken. But that said, it is a great situation in East Bangalore. And I think as a city and as builders, we need to sort of make sure we do all the responsible things required to harness as much of the rainwater as possible and store it and use it effectively. And of course, treat as much as the wastewater and make sure we're all net zero water.
Okay, well, very important there. Thanks a lot, Nirupa, for joining in, and appreciate your thoughts here on CNBC TV 18. Well, for the market, it's not bad. It's just consolidating around that 22,400 level. The mid-cap index is actually doing quite well at the moment, up 134 points. And the Bank Nifty is supporting the market. So the mid-cap index has picked up from the lows. Some dips are getting bought. Let's slip into a quick break. On the other side, we'll put focus on the commodity space. Manisha Gupta will be joining in. Stay tuned. Welcome back. Well, I just want to point out a couple of stocks that are hitting fresh highs, although the market may be flat. Just take a look at it. Indian Hotels is now at a fresh high, and this entire tourism space has been playing out very well. The other stock to look at is Inox India. Now, if you remember, Inox India, the IPO came in December of last year at around 600 or so. The stock today is at 1300. Big moves coming in on Inox India. The issue price was 627 rupees. It had a strong listing and now it's built on to its gains, more than doubled from its IPO issue price. But Mitesh Thakkar is here with us to give us more views on the market. Mitesh, what are the stocks that you're looking at?
Yeah, I think, there's some negative crossover on the charts of Reliance, so there could be profit booking. So a very, small pullback can happen. Take a short at the stop at 2950 and a target of around 2880 or thereabouts can happen over here. And the other stock which I like is Bharat Ford, which I would recommend buying once it crosses 1155. So it's making a bullish pattern. It needs to give a breakout about 1155. Buy then with a stop at 1137 for targets of 12.
All right, thanks a lot for that. Let's hop across to Manisha Gupta now to tell us about the commodity markets and what she's tracking there. Manisha.
Thank you for that, Sonia. Well, I'm looking at metals which are definitely on a high. There's a lot of support coming in for the sector from the way the dollar index has been behaving. From a 4.5-month highs, we've seen the prices decline by 1%, and that has been supportive. Also, the US Fed Powell statements yesterday where he said that lower policy interest rates would likely to be appropriate at some point in time in this year itself is where the gold and silver prices and metals seem to be taking a lot of support from. And then there are geopolitical tensions in Middle East. Markets still are looking at the impacts of earthquake that is in Taiwan. So tangible commodities actually are getting bought into. Also strong economic data that we saw come in from China for the month of Feb and for the month of March as well have been quite supportive. I want to take you through various metals and how they are trading at this point in time. So starting with copper, that one is at a 13-month high. It's trading very close to all-time highs in China. Aluminum has surged quite strongly. It has been an outperformer for last week or so. 13-month highs on that as well. Zinc has been jumping up 9 weeks high on that. Silver clearly has been an outperformer within the precious metal space in last couple of sessions. 26-week highs on that. And silver in last 2 days have jumped up by nearly 8%. Platinum also is trading at a 12-week highs. Actually, the way we buy gold in India is how Chinese buy platinum in sense of weddings and, rings, etc. So China's retail buying also has been on the stronger side. But the price clearly goes to gold, which has extended rally to record highs, now trading above $2,300 an ounce. When you look at the June futures there, they're trading at $23.25 right now. So there is a big contango, and you are looking at the further months actually trading much in the positive. For the Indian market, 70,000 is done now. And if you are going out, stepping out to buy 24 carats gold, adding all the taxes and everything, it comes to 72,000 per 10 grams of gold in the physical markets there. This is what we've done on a week-on-week and a month-on-month basis. So gold is gained up by 3.5% in this week, is up 10% on month. Silver outperforming with 9% of gains and 15% in last 1 month. Platinum as well continues to do well. I also want to bring in the industrial metals right now because we've seen stronger gains come in for this. In that case as well, copper, aluminum and zinc have done quite well. We've seen nearly 6 to 5% of gains on a week-on-week basis and 5 to 11% of a jump up on industrial metals in last 1 month as well. What the street will now watch out for clearly is going to be the FOMC meeting on 10th and 11th of June. But ahead of that, it is the US non-farm payroll data. Well, that comes in on Friday.
All right, let's slip into a quick break on that note. On the other side, we will be joined by Ajay Agarwal, the co-founder of Go Auto, and Vinkesh Gulati, the chairman research at FADA, to discuss the fall that we've seen in EV demand globally. Remember, Tesla last week announced that their sales in Q1 fell 9%, a fall in sales for the first time in 4 years. So we are going to talk about whether there is a big slowdown underway and what are the key trends in India. More on that coming in. Welcome back to Bazaar Morning Call. Well, globally, the demand for electric vehicles seems to be slowing down. Last week, Tesla reported a 9% year-on-year fall in sales, which is its first year-on-year fall in the last 4 years. And Tesla spoke about how competition has heated up. In fact, in the letter to its investors in January, Tesla predicted notably lower sales growth this year. What does this mean for the Indian EV market, which is in any case struggling with penetration, especially in the passenger vehicle space? We have Ajay Agarwal, the co-founder of Go Auto, and Vinkesh Gulati, the chairman research at FADA, joining us now. Gentlemen, morning to both of you. Ajay, let me start with you. This kind of slowdown that we've seen in the large EV players globally, do you think this is a blip or is it structural in nature?
I feel it's just a blip. In India, it has not been the same story. The Indian market has been growing. If you see, compared to last year, the Indian growth in passenger vehicle was almost 45-50%. So I don't see that Indian market getting impacted by the global trends on EV.
Okay, so this is just a blip, you're saying. Got that. Yeah. Vinkesh, what about you? What are your thoughts? Because, you know, Tesla is also coming off a very high base, right? I mean, it's in consistent growth over the last many years. And this is the first time in 4 years it's seen a bit of a knockdown. Do you concur with Ajay's view that this could be just a, 1 or 2 month phenomenon and the structural growth story is still intact globally?
So I feel, yes, it's a blip, but the kind of growth or the kind of positiveness we have been seeing in EV for so long abroad, I feel the story is not similar going further. So after the blip, whenever we see in 2-3 months the EV going up globally, it won't be at the same rate how we have seen for the past 5 years. But like Ajay said, he's totally right. India is a different story. But when I talk of globally, it has been many years since EV is prevalent there. It has been stabilized there. People have experienced 3 years, 5 years down the line, knows the positives of running an EV for more than 5 years. So obviously, it's not in the same positive mode as it is in India today.
Okay, got that. So India is a very different story is what you're saying, right? So let's talk about the Indian market. And I wanted Ajay's view first on this. Ajay, if you look at the PV, the passenger vehicle electric market in India, the adoption is very low at just about 2% It could be for several reasons. There are limited model choices, the price points are much higher. The EV adoption itself has struggled quite a bit because of range anxiety issues, charging infrastructure issues. But where are we right now? And what do you think is the need of the hour for EV penetration to increase in India?
See, this year, in 24-25, I feel, there will be more than 15 new product launches by the different OEMs. All mass market players, top 5 players will launch their new models. Everybody will have a EV portfolio in their, in their hand. So we see that this year, the EV growth will be much higher compared to previous years. Yes, I do agree there are challenges in terms of when it comes to a consumer in terms of EV adoption. Still, there's a lot of challenges in terms of charging infra. There is a problem in terms of setting up the home charging. The public infra is not so good. The power availability is not so good. Secondly, the product choices are limited. Customer has a range anxiety issue. The cost of ownership is a problem. So I think once these problems are addressed, the market will grow much faster and much stronger.
Vinkesh, come in on this. Ajay was pointing out the number of problems that have been a hindrance to EV penetration. But these are problems that have existed for the last many years. Why do you think, solutions have not been found whereby there's more penetration? I mean, we're talking about what? PV penetration is sub 2%. Even two-wheelers, which is picking up, quite a bit, the penetration is just about 5-6%. So what is lacking, you think?
See, as of now,
sorry.
Vinkesh, go ahead.
Okay, so as I feel the options available in the market is majorly skewed towards non-EV. So if you see on the car fronts also, there's one only OEM, Tata, who has some products where they can say there are 3 or 4 products. If you leave apart Tata, all the other OEMs' presence in EV is just a showcase. One product and that too not doing great. Some 100 numbers, and if you see and in here it's some 1,000, not even big. Similar happening in two-wheeler. So you have some 30-40 odd models of two-wheelers available where the fuel engines are. But when you start counting on EV, there are 10 or 15 good models which are available. And obviously these availability across the districts in India is also limited and restricted. So the customers don't have choice and reach also on the dealers front where they can get such vehicle. What I think, the OEMs are still not very focused on the electric vehicle front. There are some OEMs who are actually anti-EVs. There are some who are working towards that. But like Ajay said, we'll have to watch another year. I feel 2025 would be the year of big bang EV launches from all the OEMs. And when we have EV options available with all the OEMs in India, surely the ratio will go up, but not as high as what the government is expecting. So like latest I heard 2030, they expect 30% of passenger vehicle, some 50 or 80% odd from two-wheelers and three-wheelers. This is some kind of numbers where unless and until government goes out of the box and supports in subsidies, which is, as of now, you see FAME 3 has gone down, I don't think those percentage happening. But yes, EV ratio will go ahead year on year or month on month also.
Okay. Ajay, jump in on that. I mean, Vinkesh made a very good point. Options are very limited and the OEMs are not very serious. Apart from the Tata Group, there's no other OEM that has a comprehensive EV model. But it could also be a chicken and egg situation because, there is still charging infrastructure issues, there is range anxiety. So maybe OEMs prefer to go slow. Your thoughts here?
See, if you see off late, last 3-4 months after the price revision by Tata and MG, the mass market models like Tiago EV and Comet have started growing. So it's not fair to say that consumers are not accepting the products if it makes sense in terms of cost of ownership, entry cost. So the acceptance is there. The challenges are there definitely in terms of as of now all OEMs are not so aggressive in terms of pushing the EV products. Once every OEM has a decent EV portfolio, I think market should naturally grow. I don't see a challenge there.
You want to comment specifically, Ajay, on the two-wheeler market because, it's been consolidating for a while with 6 to 7 large players, out of which 4 players enjoy 80% of the market share. Do you think that could be the dynamics even over the next couple of years? And now you have the PLI also that has been approved. So how do you see the market dynamics change in the two-wheeler EV space?
See, again, in two-wheeler, the same problem. The OEMs who are already the leaders are not very serious. If you see the top players, Hero, Bajaj, Honda, they're not very seriously, having a EV portfolio. The EV is, as of now, being, the startups are leading the EV ecosystem. The automobile is not a business wherein, you can build the channel, you can build the infrastructure overnight. It takes time to build that. Unless the existing OEMs try and build that, use the existing infrastructure to push the EV, it will take time.
But can it also be the case that, as you mentioned, right, startups are leading the EV ecosystem. Vinkesh, I want you to come in on that. Will it be very tough for the startups to sort of scale up this business in a big way? And is it mandatory for the incumbent players, the legacy players to sort of scale up their business for the penetration to take off in a big way in two-wheelers?
You're right on your point. See, companies like TVS who have really gone out of the way to launch EVs through their regular regular dealers have really seen some tandem going on. They are doing now 12,000 plus or 15,000 every month, which is the only company legacy player who is doing something in EV. Like you talk of Bajaj, they have only one product, which is Chetak, and also their presence is not there all over India. Talk of Hero. They have come through one product and still their presence is less. Honda motorcycle has yet not launched an electric vehicle in India. So if you see the legacy players, I feel they are still waiting for I don't know what. But unless and until these 4 legacy players go out of the way, have an EV portfolio through their regular dealers and don't think of having a special EV dealers separate, then the reach becomes a problem. So until and unless that happens, I don't see EV market going big in two-wheeler. No doubt it's one of the best if you talk of compared to cars or CVs. But still the melting point or the top point is still there. I'll give you a small example. I'm talking of one small district where one OEM sells 1,000 products per month, whereas its EV portfolio is selling 30 vehicles per month. And that's how where major districts of India is going through. If you talk of leave apart the TVS for Hero or Bajaj. And that is where the major problem is. Similar what has happening in passenger vehicle, is happening in two-wheelers also. The OEMs are not focused towards EV, and they're not coming up with options.
Okay. Ajay, one final word from your end. Is Chinese competition a big threat in India? Because globally, Chinese competition has sort of, become a big threat. But what about the Indian markets?
I don't see that. See, last few years, we have been hearing a lot of stories of Chinese PV makers coming in, Great Wall Motors and other players. But it's very difficult. Automobile is not a fly-by-night operations. You build up quickly and then establish. So I don't see much challenge there. And definitely the rules and regulations and the laws doesn't give them a free way to run the business in India.
Got it. All right, gentlemen, we've run out of time, but not out of questions. Thank you so much for explaining, the entire EV ecosystem to us and the slowdown that we've seen globally after Tesla announcing that they've seen a drop in sales. With that, it's curtains down on Bazaar. Thanks a lot for watching.
The Indian market opens at a fresh record high. The Nifty crosses 22,600 for the first time ever, while the Nifty Bank moves above 48,000. Currently, both of them off the highs, even as the mid-cap index crosses that 50,000 mark for the first time.
HDFC Bank gains on the back of a robust deposit growth in the fourth quarter. The deposits are up 7.5% sequentially. The CASA ratio also improves to 38.2% on a quarter-to-quarter basis.
Avenue Supermarts also surges as the revenue for the company grows about 20% in the fourth quarter. Store addition also picked up with the company adding 24 new stores compared to single-digit additions in the past 3 quarters.
KEC International surges 12% on order wins worth 816 crore rupees across businesses. The total order intake for FY24 is around 18,100 crore rupees. In fact, in a short while from now, we'll have the management on our show to discuss this order win.
Oil India slumps after the government increases windfall tax on petroleum crude to 6,800 rupees a ton from 4,900 rupees earlier. The windfall tax on ATF, diesel and petrol continues to be nil. This is the 5th increase in windfall taxes since February.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangalam Malu. And as we speak, well, the markets are as flat as can be. The pocket that still continues to party is the mid-cap index because that one is in the green. The breadth of the market as well still favorable, though the markets have come off the high point of the day. You know, Mangalam, it's since the IPL fever is underway, you know, it's like the batsmen came out there, they got off to a cracker, and then in fact, no, the run rate has just dried up. And that's why we've come off the high point of the day.
You mean to say the power play overs got over and thereafter you had those smart, fast bowlers coming in, the likes of Mayank Yadav, etc. But you know what? Maybe the market wants to take it easy ahead of two important events. One is the weekly options expiry today, and tomorrow, of course, is the RBI policy outcome. So maybe they said, okay, let's not hit the extremes yet. We have hit a record high. We had milestones on the Nifty as well as the mid-cap index as well, 50,000 on the mid-cap index and 22,600. Let's see where that goes.
Well, talking about bowling, Mayank, what a fantastic spell. And last night as well, no, that delivery from Ishan.
That Yorker was incredible.
I mean, that was some solace after the kind of whacking they were getting. But what a delivery. Bending their back end, you know. But let's get back to the market.
Let's get back. You know, the two extremes of the market we spoke about as well. Ishan Sharma, the senior experienced bowler, and then Mayank Yadav, who's a fresh upstart. Where do we go from here? Shivangi Sarda of Motilal Oswal Financial Services joins in for a quick check on the IPL. No, Shivangi, the market. That's what we're going to talk about.
Thankfully, the market. Good morning, Mangalam and Nigel. Thank you for having me on the show. So we have seen that, you know, there has been a very strong support-based buying, although Nifty is witnessing some sort of profit booking decline. But then, of course, at higher levels, this is pretty much natural. And it is still, you know, respecting its crucial support zones of 22,350. So this level would be important to watch out for. 22,350, you know, it has to hold these levels for an up move again to, you know, around 22,600 and then 22,750 levels. Overall, you know, the series data have been quite positive, and the way the Nifty is panning out with stock-specific action across the sectors, it's going to, you know, likely to be on the positive side in the entire series. Now, talking about Bank Nifty, you know, this series, we've seen that the rollovers have improved very significantly. And there has been, you know, consistent outperformance as we have seen in the last 3 to 4 sessions. Of course, a little bit profit booking decline, but then, of course, it's good levels to watch out for. So over here, we are recommending buy on decline. The expiry day point of view might be a little range bound for Nifty, but Bank Nifty is definitely a buy on decline over here. The next targets which are coming out is 48,250 levels and with a stop near 47,350 zones.
Okay, sounding more optimistic on the Nifty Bank rather than the Nifty. We got that, Shivangi. What about individual stocks? What are you looking at?
So, individual stocks, I'm looking at NTPC, which has recently come out of its higher band, its hurdle zones rather. And from the last 3 weeks, we've seen that there has been a very consistent, strong support-based buying. RSI is showing a positive divergence here as well. And this stock has, you know, consistently been one of the performers in the entire space. Even in the previous series, we've seen 86% rollover, which have been carried for this series. So overall, the stock is likely to remain positive and extend its move. You know, buy recommendation over here with a target of 375 and a stop near 355 levels. The second pick on my radar is CUB. Now, this entire space is also coming out of its underperformance and lackluster, come out of its consolidated band. After, you know, consistently moving in a very narrow range, this stock is now set to perform with, of course, tailwind of the sector. And the next targets are coming out to be 162 over here with a stop near 152 levels.
All right, Shivangi, thanks a lot for joining in and giving us those picks. We have City Union Bank as well as NTPC. On the other hand, we have AU Small Finance Bank as well, which is the top earners in the F&O space right now, up around 6% on the back of strong update coming in. Let's shift focus to a special segment where we get you a few ideas for profit coming in from our colleagues at Money Control Pro. We have with us Nitin Sharma, who's joining in to talk about a stock that he's been tracking closely. Nitin.
Today's idea for profit is Intellect Design Arena, a BFSI-focused IT product company. Intellect offers software products and SaaS solutions to banks, insurance, and investment management companies. Global BFSI spending has been rising at a CAGR of 9 to 10%, with a shift to cloud, AI, and SaaS, creating a large market for established third-party product companies such as Intellect Design. Within the BFSI space, shift to SaaS is picking up, and this market is expected to grow at a 30% CAGR for the next 4 to 5 years. Intellect has done heavy investment in the product development for years, and those products are now mature, therefore do not require heavy investment going forward. Further, lower OPEX on the SaaS business and a rise in large deals put Intellect in a sweet spot to grow revenue at a double-digit rate and achieve margins similar to the global players, which enjoys above 30% margins. Intellect trades at a discount to its peers despite a better growth profile due to the ongoing transition. At the current market price, it trades at about 26 PE of 24 times, which is reasonable, and should see a re-rating driven by the earning growth. Company plans to enter in the US market with increase in the number of deals as well as the size. We therefore recommend a buy.
All right, Nathan, thank you for that. With that, we'll step into a short break. But as we do that, here's something you must not miss out on. CNBC-TV18 presents India Exchange, where market experts and industry stalwarts will collaborate in insightful discussions on India's economic path and the evolving dynamics of the Indian market. We'll be mapping the macros with City India economists Sameer and Chakravarti, catch a jugalbandi between market veterans Manish Chokhani, Ramdev Agarwal, and we speak about the return of animal spirit within India Inc. as well. This will be a conversation with V. Vaidyanathan of IDFC First Bank, KK Mistry, and Manish Kejriwal of Kedara Capital. Chasing alpha for market experts like Nilesh Shah of Kotak, Prashant Khemka of White Oak Capital, and Ansh Tawakle of ICICI Pru MF will be there as well. Stay tuned and do watch CNBC TV18 today evening, 5:30 p.m. onwards. Well, the Nifty is flitting between green and red. NTPC has, of course, moved higher, and Divi's Lab continues its move from yesterday as well. There was a double upgrade coming in from a brokerage firm, and that stock ended about 3% higher yesterday and today as well. Opened a little flat, but Divi's Lab has now moved to the high point of trade with a gain of almost 2%. Coal India is the other one, which is doing well from the frontline end as well. But let's talk about some important news that Hormuz has got, which is the market, which has seen a stellar run over the last 4 years. This morning when the Nifty crossed the milestone of 22,533, it had risen nearly 3 times from its COVID low of 7,511. Hormuz is here to decode this journey. Hormuz will talk about that. Nigel and I, we were there to see that 7,511. Nigel, who would have thought 3 years from then it is 3 times?
Well, if hindsight was foresight, then everyone would be
horses.
Everyone would be millionaires. But what a journey, right? 7,511. But let's not take the spotlight away from Hormuz. Hormuz, you take it away.
Well, we are in a market where in an up day is any other normal course of business, but a down day is also not termed as a trend reversal anymore or things going awry, but an opportunity to buy more. But little did we know, as you said, on the 24th of March 2020, that we would be here standing 4 years later, celebrating the Nifty scaling one new peak after another. And this happened a day after the nation went into a lockdown to combat the pandemic. The Nifty making a low of 75.11. Since then, the Nifty has tripled from those levels after it crossed 22,533 in today's session. Of course, the broader markets have been bigger outperformers. The mid-cap and the small-cap indices are up well over 300% as we speak. The realty index also is among the top sectoral performers with gains of over 400%. But the top sectoral gainer is none among your usual suspects, the ITs, the FMCGs, none of them. It's PSU banks. The stellar run in the state-run lenders has taken the PSU bank index higher by 440% from its March 24th lows. Now, what among the Nifty has moved since the most that day? Adani Enterprises tops the charts there, and then comes Tata Motors riding on the back of a stellar run in 2021 and in 2023, and this year it's already up another 30%. And then comes the metal names, Hindalco, JSW Steel, Tata Steel, and the infrastructure giant L&T also gaining over 400%. On the flip side, there are some stocks that have barely moved, and HUL is a case in point. They're just 12% in the last 4 sessions. Now, as they say, the proof lies in the pudding, and what more proof do we need to show the kind of market we are in, that after a 129% surge in 4 years, TCS features among the worst performers on the Nifty. Now, within the broader markets, we have 17 stocks in the mid-cap index that have risen over 1,000% or more. And CG Power tops that charts, followed by KPIT Tech, BSE, FACT, and even Poonawalla FinCorp. And cannot not talk about Suzlon in a market like this that features in this list as well, along with stocks like RVNL, Persistent Systems, and Tata Elxsi. Now, if there are 17 mid-cap stocks, there are 24 small-cap stocks as well that have gained over 1,000% since March of 2020. There's the list here goes like Tata Tele, JBM Auto, Titagad, BLS International as well, along with Electra Green Tech, while stocks like Apar Industries, Ramkrishna Forgings, Tejas Networks also find a mention here. So there you have it, the Nifty 3x from its March 2020 lows, and hopefully there is more to come as well.
Well, Hormuz, you started off the link by saying, who would have thought we are standing? At that time, we didn't know what's going to happen the next day.
Whether we would stand or not.
Absolutely. But thanks a lot for that. Well, let's move on then, and let's shift focus to the IT pack now. Brokerage firm JP Morgan has turned bullish on a couple of those IT stocks. Rima joins us to fill us in with more details. Rima?
Thanks so much for that. I like the title of the report. They're saying, how do you make money in IT now with the recovery having been pushed into the second half of the year? So JP Morgan has 3 ideas. There are 3 upgrades that they've done. One of them is a persistent system. They've upgraded it to an overweight. The second one is an upgrade on LTI Mindtree and also an upgrade on KPIT Technology. But here, they've gone from being underweight to neutral. So the maximum upside from current levels is perhaps in persistent systems, where the target price is 4,400 rupees. Now let's get to why they've upgraded these 3 individual names. On LTI Mindtree, it's an upgrade because the stock has underperformed. Since the company came out with their Q3 numbers, LTI Mindtree shares are down 22%, underperforming the broader market and even the Nifty IT index. Persistent Systems has been upgraded on the back of an earnings upgrade. Now, JP Morgan has raised the revenue estimates on Persistent Systems by 2%. They're forecasting a bigger margin expansion, and that's driving a 5% earnings upgrade. And finally, on KPIT Tech, the reason for the upgrade are the large deal wins, which according to JP Morgan will close in FY25, helping the company achieve a 20% earnings growth in both FY25 and even in FY26. Now, quick word on what they expect. when it comes to Q4 numbers. They believe that the markets will largely ignore Q4 numbers. Now, FY25 guidance by Infy and HCL Tech, the annual guidance, could disappoint a few people if Infy comes out with 2 to 4%, if HCL Tech comes out by 4 to 6%. But here is the important line. JP Morgan says that given recent underperformance by NSE IT, they believe the downside from here on could be limited. Back to you.
All right, Rima, thanks a lot for that. The downside could be limited, and how do you make money on the IT space? Well, the report has some ideas for you, and Rima's put that up for us as well. Let's slip into a short break. As we do that, let's share an announcement with you all. We're launching CNBC-TV18's first ever live personal finance webinar. It's called CNBC-TV18 Accelerate. It's the personal finance handbook. It's with Sonia Shenoy, where she'll be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances, which is learn how to grow your wealth, be it insurance, tax savings, managing your portfolio, retirement planning as well. So lots to learn and lots to do as well. Whether you're in your 20s, 30s or even 40s, this live webinar is actually for you. There are limited seats, so don't miss this chance. Register now. What you can do is scan the code, the QR code which is there on your screen, or log on to CNBC-TV18.com. We'll see you on the 11th of May.
Well, KC International, that's the one that's buzzing in today's trading session, making fresh highs after they won an 816 crore order across various businesses. To help us understand more about that, we have Mr. Vimal Kejriwal, who is the Managing Director and the CEO of the company. Hi, Mr. Kejriwal, the first time we're speaking to you in this fiscal, and you have started it off in style. Yeah. Break up this 816 crores for us first, between civil, T&D, as well as cables business. What's the split?
It's morning, Nigel. And basically, this is almost civil. It's almost 93-94% is civil, and very small part is cables and T&D.
All right. So 93-94% is civil. The rest is cable and T&D. If we look at your order announcements and the FY24 order inflow guidance that you had given, you seem to have fallen a little short. Could that be because some of the orders have spilled into FY25? What's your FY25 order inflow target?
So, Mangalam, you're right. We had talked about 20,000 earlier, then we had said 18 to 20. Fortunately, at least we have crossed the lower level. We have reached 18,100. We have roughly around 5,000 crores in L1. A couple of them have got hit by the election code of conduct. So they are with PGCL and other people, which we were hoping that they will be released before the election, but it's not been released. So that's the slight setback. But I think we are okay otherwise. For next year, we are talking about around 25,000 crores of order intake.
Okay, all right. Mr. Kejriwal, one of the reasons that you have also, your inflow is only 18,000 crores in comparison to 20,000 crores is because you were making this point that you want to be selective and you want to focus on profitability as well. That's the analyst community has understood that well. So, what is the margins on this 18,000 crores approximately? And also, we have been covering for the last few days, aluminium prices, copper prices, all of them, they are off the blocks in style. That could hurt your business. What is the margin outlook should we be working with for FY25? And is that at risk?
So Nigel, you are right. We have become very selective in our order intake, minimum sizes, cash flows. I think we had a couple of bad years earlier, so we became very careful on that. So that's one of the major reasons why we are at 18, not at 2022. As far as the metal prices are concerned, as of now, it's not hurting us because all the current orders and etc. are fully hedged. Okay, where it can hurt is, an industry like cable and all that, where with the copper prices, aluminum prices going up, sometimes we see a scale down of, ordering, etc. by some of the user industries. They would like to wait. But I think the prices have been very volatile. I don't see any significant impact anywhere. In fact, what happens is the other way around is, in the newer orders, if the prices are higher, your values go up and your order sizes and everything goes up. And typically, since we are at a margin percentage of the value, the margins can also actually go up in absolute terms.
Okay. So you're telling us that this commodity price increase is not a risk to your profit profile, the way you see it. Then give us a guidance on margins for the coming year. And by when do you go back to 9% margins?
So margins for next year, we have just been talking about between 7.5 to 8. And we have said that FY26, we should be between 9 to 10.
All right, 9 to 10 for FY26 with 7.5 to 8%. You haven't changed much from what you had earlier said as well. In the fourth quarter as well, you said you would do margins of close to around 7% with the annual revenue growth of 15% in FY24. I just wanted some granularity on, your non-T&D business or rather your non-civil business. Railways, what's your outlook for the next year? Cables and also the EV charging cable that you're talking about. How are they likely to grow in the next couple of years?
So cables is doing very well. We do think that next year cables will do still better. And one of the reasons why we are saying that is we have also started working on our aluminum conductor facility, which will get up by Q2. So that will add, on an annual basis, almost 600 crores of revenue. So cables will do well. EV charging is still down. To me, the cable part is still in its infancy. So I don't see it growing too much. Railways has been a bit of a disappointment in terms of our line of business, where we are more on infrastructure, building new lines, electrification, and the government emphasis was more on, Vande Bharat trains and station redevelopment. So I think our view internally is that post-elections, I think the government will change tracks and start spending more on infrastructure. So we do think that we'll see a lot more tenders on railway infrastructure, railway safety, etc. coming up. So hopefully by Q3, Q4, our railway order book should start building up significantly.
Okay, all right. Mr. Kejriwal, we'll talk in further detail when your numbers are out, your quarterly numbers are out. But I recall you telling us that I think the net debt number will reduce by roughly around, 500 crores in Q4. Has that happened? And your net working capital days as well, you were guiding for 15 to 20 days improvement. Has that happened also?
So I don't want to talk too much about FY24, but I think I can only say that we are on track on our debt numbers.
Okay. And what about for the coming year? So let's not talk about FY24. FY25, give us the guidance, right, on both debt as well as net working capital days.
So FY25, we don't expect the absolute debt to go down, because what will happen is that we are talking about a 15% growth in revenue. So we will need to borrow more to fund the extra 15, let's say almost 3,000 crores of revenue. But we expect that the absolute debt will remain where, and also interest as a percentage of our debt to come down by at least 50 basis points on account of our working capital improvement. And hopefully, if RBI does something and the rates start coming down, then that could be an additional reduction in our interest cost.
All right. Working capital days you're going to give us?
We should be between 100 to 110.
Okay, 100 to 110. We'll take that and speak to you in more granularity, in a lot more detail after your fourth quarter numbers as well. Thank you so much for joining in. From what we have so far, 15% revenue growth for the next year, 7.5 to 8% margins, with them moving to 9 to 10% in FY26, 25,000 crore worth order inflow, and an improvement in working capital days to about 100 to 110. That's KEC International, stock up 13%. With that, we're out of time on this edition of Chartbusters. Thank you so much for watching. From Nigel, me, the entire team. Stay tuned. Trading Hour comes up next.
The RBI governor will hold the first meeting of the new financial year amidst a backdrop of high growth, falling core inflation and stable macro parameters. Will the RBI raise the growth forecast or tread with caution? And how will this impact you, your EMIs and your bank deposits? Catch the RBI monetary policy along with instant analysis only on CNBC-TV18. The RBI monetary policy at these times.
Good morning. Welcome to Trading Hour. It's 8 Thursday morning. I'm Reema Tendulkar. With me, Surbhi Upadhyay. The Nifty and the Sensex are sluggish. They're in the red, not by a whole lot, just down about 0.25%. But banks is where the action is. The Nifty Bank is up 250 points, and it's all courtesy one stock, HDFC Bank, right?
Yes, finally, you know, we're talking about HDFC Bank. Yeah, as the leader, the giant has risen, I guess, is what you were going to say. And it's really powering the Bank Nifty, because otherwise trends have been fairly muted once again. It's been a week of consolidation. 150 points between the low and the high on the Nifty. That's all we've managed throughout, this week, actually, is what I'm saying.
The lower end of that trading range is where the Nifty is right now, closer to 22,350. Higher end of that range is 520 thereabouts. So it's just consolidation that continues. We will spend a lot of time telling you why HDFC Bank is doing what it is. But on the flip side, look at the other drags. Reliance just has not been contributing. A couple of other names like Bharti, and even within banks, HDFC Bank is a bit of a lone ranger. Some of its peers like ICICI is on your screen. Look at IndusInd Bank, not really contributing too much. So within banks, it's really an HDFC Bank powered rally. But Reema, today is after many, many days, we don't have a very healthy advance decline ratio also. So it's not like the mid-cap market is lighting up as was the trend till now.
And one more point, absolutely, the advance decline ratio split right down the middle, the two lines have converged. Just getting back to that point about HDFC Bank, not just today, but even earlier this week, HDFC Bank had outperformed. Week to date, HDFC Bank is up 4.5%. 4.5% on a week-to-date basis, while Kotak Mahindra Bank and ICICI Bank are down 2.5% this week, which means in this week, HDFC Bank has outperformed its peers by close to about 7%. So even in the run-up to that quarterly update, buying had emerged in HDFC Bank, and that's clearly the big story of the day. But we have Gautam Baid from Complete Circle Stellar Wealth PMS joining us on the show now. Gautam, started the new fiscal year. It's been a good start. We have a lot of tailwinds also in front of us. The elections where political stability is likely to continue. India's macro looks fairly resilient. But it's just that after the kind of year we've had, last 2 years, it's all about picking individual stocks. So how do you navigate through this volatility and your view on the market?
Sure. So first of all, good morning, Surbhi and Reema. Pleasure to be back on your show. You're absolutely right that the valuations in the broader market, especially for the quality names, is still pretty expensive. Early in March, there was a short-term sell-off, which led to the hope that maybe we could get more reasonable prices. But quality names tend to get bid up very fast after every correction. And that is exactly what we saw in the last few weeks. The quality stocks are the ones which have bounced back the fastest. And I believe from here on, the markets will become more narrow. And the focus will shift to those stocks with strong earnings growth visibility and which are enjoying sectoral tailwinds, because they are the ones which will find buying favor after every correction going forward. So one needs to be very selective and have a bottom-up approach, not go down the quality curve and not compromise on valuations. I think if you pay attention to quality and valuations and growth, this holy trinity, then you can do pretty well over the next few years.
Okay, so you have to be focused, stock specific, and ensure you stick to quality. Got that, Gautam. Great to have you on the show as always. Since you're telling us to be focused and specific, we really want to discuss two of the themes that you're tracking. Starting first with the BSE. Now, before I ask you the question, I must put the rally in context on BSE. So, guys, can we just pull up a one-year chart? I mean, this is a stock that has gone places and how. The one-year gain on BSE is already 533%. Let's get that one-year chart going on BSE, the Bombay Stock Exchange. There you go. What a move on this stock. It's not alone. A lot of the other plays around the capital markets, infrastructure sort of stocks, which are exchanges, whether it's MCX or brokers like an Angel One, etc. They've all moved higher. BSE has been absolutely phenomenal. So, Gautam, the question, what do you still like about this story, and does it still have the momentum to keep rising despite this huge move?
Well, so in our view, BSE Limited is one of the best operating leverage plays in the listed space in India, and there is significant scope for margin improvement as the business gains scale, because a large part of BSE's business is largely fixed cost based. So firstly, BSE has made considerable progress on the Sensex 30 index option contract, while BankX is seeing healthy traction on the expiry days. The management's focus now is to bring non-expiry volumes and to introduce long-dated contracts beyond the current expiry. And it also plans to gradually increase the tariffs on Sensex and BankX contracts beyond the current week. And that is going to be the big operating leverage catalyst for BSE. Secondly, BSE as of today enjoys a 5% market share in the index option premiums in India. And for now, the management is more focused on growing its market share by getting more brokers fully enabled on BSE's platform. And once fully enabled, the company expects its market share to grow further. in most cases, BSE charges much more lower than NSE, as high as 40% lower in certain cases. And that's why in some cases, the business is not profitable right now, but the management wants to rationalize and improve these charges, these broker charges going forward as the business grows and gains scale. Currently, BSE is trading at a 1-year forward P multiple of 40x on FY25 basis. And given the strong earnings potential over the next few years, driven by operating leverage, we expect these premium valuations to sustain. However, I would like to highlight the two key risks with BSE's business. Number one, any significant regulatory clampdown on the derivative segment can be a headwind. And second, any slowdown in the equity market participation can also be a headwind for BSE, because at the end of the day, its fortunes are linked to the capital markets. We own this stock in Complete Circle's Stellar PMS as well as Stellar Wealth Partner India Fund portfolios.
What was the price at which you entered BSE in your portfolio? Because just looking,
it was very decent, Reema. We bought it around 2,300.
Okay, and what's the upside that you see? It's already at 2,800. The stock has corrected in the recent past, but do you have a fair value in mind at which point you will reassess your holding in BSE?
Very difficult to assess the exact fair valuation for a non-linear business like this, Reema, because just like we discussed previously for multi-commodity exchange MCX, the earnings growth can be very non-linear in such cases, because in such high fixed cost businesses, and that's why the key in such stocks is to just stay invested throughout the high growth phase of the company, because in such businesses they start off from cheap valuation, then they go to reasonable valuation, then they go to expensive, then very expensive, and then they ultimately enter a blowout phase. But we are still some way away from that. I think right now the valuations seem reasonable at 40 times 1 year forward. And if you look at the most recent brokerage reports on this company, they are expecting EPS CAGR over the next 3 years of more than 50% for BSE. In the absence of any regulatory clampdown, that's a very important point, because we have seen in the recent past that the regulator is trying to just reduce the exuberance in the futures and options segment. So we'll cross the bridge when we come to it, but for now, the prospects look pretty strong for BSE.
Okay, there is one more stock that you're recommending, which I think you hold in your PMS also, Equitas Small Finance Bank. Tell us more about it. Why now?
So Reema, I think the recent stock price underperformance of Equitas Small Finance Bank is presenting an opportunity for long-term investors, because this stock at the current price offers earnings growth visibility as well as potential for valuation re-rating. The credit to deposit ratio for Equitas Small Finance Bank, this is a ratio which many analysts track in the banking industry, especially in the recent past. The credit to deposit ratio for Equitas Small Finance Bank is expected to moderate with deposits picking up, and deposit mobilization has been pretty robust for Equitas in the last few months, primarily driven by the rise of retail term deposit products of 444 days and 888 days. That is where the bank is offering very attractive interest rates to depositors, and that's why the CASA ratio is improving for Equitas Small Finance Bank. If you speak about valuations, currently Equitas Small Finance Bank is trading at a price to book on FY26 basis of 1.4 times, and we believe these valuations are very attractive because of 4 primary reasons. Number one, over the next 3 years, the expected growth rate in the loan book and the earnings for this company is expected around 23 to 25%. This is the management guidance. Secondly, Equitas Small Finance Bank is going to be a significant beneficiary of the upcoming rate cut cycle, because 82% of Equitas Small Finance Bank's loan book is at a fixed rate, and that will ensure a quick recovery in its net interest margins when the rates soften. So that may lead to further re-rating of the company. Third factor which can drive re-rating for Equitas is ROA, return on asset delivery of 2%, with room for further ROA expansion over the next few years, driven by a steady cost to income ratio, improving net interest margins, and benign credit costs. So that may also, and we have seen in the private banking space in India that banks with an ROA of 2% or more generally trade at a price to book of 2.5 to 3 times. So there is sufficient room and valuation comfort here at the current price. Finally, what can lead to re-rating of Equitas Small Finance Bank in our view is the well-diversified loan book. 81.5% of Equitas loan portfolio is in non-MFI. So 81.5% of the loan book is secured in nature, and Equitas Small Finance Bank also has a better CASA ratio compared to most of its peers. The CASA ratio stood at 32.7% at the end of Q3. And that also gives us comfort that going forward, as investors look at the broad metrics of this company, we may see some valuation re-rating. The key risks for this company, though, are intensifying competition for deposits, which can put pressure on net interest margins. And the second risk factor for Equitas Small Finance Bank is worsening asset quality and its MFI book.
Okay, fair enough. So that's the upside.
Disclosure, we own this stock in our India Fund and PMS.
Got it. So you own the stock. You've laid out a couple of the reasons why you're quite optimistic on it. That's an interesting point about the large chunk of their book being fixed. So when we get into this downward rate trajectory, this is not a company that will be as impacted as perhaps some of the others. So interesting one. Gautam, stay on because we're on the subject of financials. We want a broader view, with you as well on overall beyond Equitas. And let's start with what other than today's big newsmaker, HDFC Bank. We've got Abhishek joining in. So Abhishek, tell us, how do those deposit mobilization numbers look? Because that's what it's all about, right? The fight, the chase for deposits.
Well, in a tight liquidity scenario, they have been able to grow their deposit base very strong on a sequential basis. The deposits are up 7.5% quarter-on-quarter. In incremental wise, it's up 1.66 lakh crore in a tight liquidity scenario when it was up 1.5 lakh crore when the liquidity was good in Q4 of FY23. Even on a sequential basis, the incremental deposit growth is 4 times of what incremental deposit flow they saw in Q3 FY24. CASA ratio has actually improved on a sequential basis. We have seen CASA being a tough spot for many bankers, but HDFC Bank has been able to improve its CASA ratio by about 45 to 50 basis points despite strong deposit growth. Retail deposits are up 6.9% sequentially. Advances growth are on weaker side at 1.6% sequentially. Domestic retail advances have grown by 3.7% sequentially. Commercial and rural banking have grown by 4.2% quarter-on-quarter. Now, other wholesale loans that have declined by 2.2% on a sequential basis, and that's impacted the overall advances growth this time around. CD ratio, that's dipped sharply to 105.4% when compared to 111.5% in the previous quarter. Back to you.
But I guess, Abhishek, that's along, expected lines. I mean, I'm guessing this is a strategic move because in any case, I guess it's become more about shoring up deposits. Perhaps, bigger banks feel that loan growth will take care of itself. But, Abhishek, what about the others? We've got updates from a whole lot of other lenders, right? What stands out for you?
Well, 3 of them that stand out. If you take a look at the AU Small Finance Bank business momentum, it's been pretty strong and it continued even in last quarter. So deposits are up 25.7% YOY and about 8.8% quarter-on-quarter. Now, CASA ratio continues to decline. It's now down to 33% when compared to 33.9% in the previous quarter. It's an industry trend. AUM growth is pretty strong at more than 28% YOY and close to 8% quarter-on-quarter. Cost of funds that continues to inch up, and it's now at 6.98% versus 6.9% in the previous quarter, but the incremental pace has actually started to reduce for them. Suryodaya Small Finance Bank, robust business momentum actually continues over there. Deposits are up nearly 20% quarter-on-quarter. CASA ratio has actually improved sharply to 20.14% when compared to 18.5% in the previous quarter. In absolute value, CASA deposits are up more than 30.5% quarter-on-quarter. Disbursements are strong, growing at 38.6% YOY and about 30.6% sequentially. AUM growth is robust at 41.5% YOY and close to about 13.8% quarter-on-quarter. Their asset quality has also seen a marginal improvement with gross NPA ratio being down by 10 basis points quarter-on-quarter. RBL Bank, now again, the deposit growth over there is pretty solid over there. So deposits have grown by 21.9% YOY, which is one of the highest that you are seeing in last 3 years. Sequential deposit growth is about 11.55%, which is the highest that you are seeing in last 5 years on a sequential basis. CASA ratio, that's improved sequentially. That's a heartening point to see. 35.2% CASA ratio in Q4 versus 33.8% in the previous quarter. Loan growth 19.2% YOY is the lowest that you are seeing in last 3 quarters, and it's up about 4.6% quarter-on-quarter. Their CD ratio, now that's declined sharply by 550 50 basis point on a sequential basis. There could be some pressure on the net interest margin, but we'll wait for the results to come out. Back to you.
Okay, thank you very much for that. Gautam, are you surprised by the aggressive deposit mobilization that we've seen across from the ones which have reported their quarterly updates, HDFC Bank and even the others, as Abhishek was pointing out? Has that taken you a bit by surprise? Do you think this could be an industry trend? And therefore, is there a risk to margins?
Well, Rima, you're absolutely right that this intensifying competition for deposits can lead to NIM compression, but over the last few months, we have been seeing a lot of banks giving very attractive rates to the depositors to attract these deposits because of the RBI mandate to bring the credit to deposit ratio down. But I think, leaving this part aside, I would also like to add one important point here that, in the investing field, I think we should focus on those areas where there is decreasing competition. Right now, in the banking sector, you are seeing a lot of increasing competition for deposits, but there are certain areas within financials where the competition is actually reducing. I saw the ticker of Muthoot Finance flashing on your screen a short while ago. And in that particular industry, because of the RBI's recent actions against IIFL Finance for its gold loan portfolio, the competitive intensity is greatly reducing in that particular industry. And therefore, the leader of the organized pack, that is Muthoot Finance, may benefit the most. And it's a leverage play on increasing gold prices. And just earlier today, gold prices crossed $2,300 an ounce. So I think that looks like a very interesting play, and the valuations are very reasonable. So that should be definitely researched a bit.
Okay, just one quick word. Avenue Supermarts, right? This was a sleeper stock. But, in the last 1 month, some brokerage upgrades started coming through. ICICI Securities, CLSA initiated coverage. And then this quarter's, quarterly update looks quite good. Is Avenue Supermart a part of your PMS, or is it, are you looking at it actively right now, given the underperformance, and therefore maybe its time has come?
Well, Rima, in spite of the recent underperformance, the valuations are still very nosebleed in our view. It's extremely expensive, and we do not have coverage on Avenue Supermarts in either our India Fund or our PMS. And in our PMS and India Fund, we look for companies which are growing much more faster on a secular basis. And unfortunately, Avenue Supermarts does not fit our criteria there. So neither the growth criteria, neither the valuation criteria, neither of the criteria are being met here.
Okay, so that's Avenue. Gautam, before we let you go, I just have a broader question, observing what's been going on with discretionary consumption, right? This was a week where we got to know that the Aditya Birla Group is now splitting their fashion and apparel business as well. I mean, Aditya Birla Fashion and Retail is getting split down the middle, and we know what Trend has done. So, A, do you have any interest in this space, which is discretionary urban consumer, maybe through apparel, maybe through any other format of consumption? And B, if you do, then what's the sense? I mean, how should we look at, perhaps playing this? Gautam? Yeah.
Yes, sir. I missed the last part of the question, but yes, we do have exposure to Cello World, as discussed in our previous interaction. Our exposure to discretionary consumption. It's a leader in opalware, glassware, and consumerware, and that is where we have exposure. And most of the other consumer discretionary stocks, the growth rates are not really that appealing for us right now to take exposure, but we're monitoring this space pretty closely because this is the time when the sector is undergoing a bit of a short-term headwind and a bit of a slowdown, that you can buy into good quality franchises at reasonable prices. So we are actively monitoring this space.
Okay. All right, Gautam. Good chat with you as always. Thank you very much for joining in. We look forward to the next one. You have a good rest of the day. Thank you.
Thank you.
All right. Well, with that, we do have to take a quick break. Markets are absolutely flat. It is all about the Bank Nifty, courtesy HDFC Bank. We'll take that break, come back and actually also look at commodities, see what's happening on that side of the market. Manisha Gupta is going to be with us.